What does the future hold for the economy, and how should you be investing right now? Joining me today is Rick Rule of Sprott U.S., and I'm David Lynn of Kitco News. Rick, welcome back to the program. It's always a pleasure.
A pleasure. I'm delighted to speak to the Kitco audience.
To the viewers watching right now, at the end of this video, we'll be showing you two very important charts. As well, Rick will be sharing with you how you, the viewer, can get involved and participate in this discussion. So stay tuned and watch until the very end of this video. Rick, let's start today's discussion by talking about the economy at large. Do you agree with government policy response to the pandemic right now, and can the governments turn this crisis around?
Great big question. I see us in an unwinding of 10 years of economic expansion. And I suspect that 10-year economic expansion, post the 2008 crisis, was more a function of excess liquidity, which is to say quantitative easing and artificially low interest rates, than it was strong regional economies anywhere in the world. Before the COVID-19 virus, it was my expectation that we would have a long, slow, grinding recession, a sort of a 2 or 3 year reset. The COVID-19 virus was obviously a pin that put that prior bubble to rest. And so the recession, I think, will be much sharper, although perhaps of the same sort of duration. From the point of view of the Kitco audience, largely precious metals investors, the policy response that we have seen, which is more liquidity, more spending, more debt, more deficits, while it is very bad for the economy as a whole, is very good for precious metals investors, which is most of the Kitco audience. The policy response will reduce faith in savings instruments denominated in fiat currencies, including the US dollar. And this has already shown up in the physical gold market.
That's a great point you're bringing up, and we'll get back to precious metals in a minute. On the point about policy response, I've heard lots of criticism about too much or excessive monetary stimulus. But what other choice did the Fed have at this time?
I think that the underlying economic condition had as much to do with debt and deficits and excess liquidity, that is to say, the securitization of the broad economy that happened 10 years ago. Society as a whole has come to hope that the big thinkers can get us through our circumstance rather than causing us all as individuals to become, in Nassim Taleb's phrase, anti-fragile. The truth is that society at every level, personal, corporate, and government, needs to have less debt and more savings. We all need to live within our means. The circumstance where we have decided to deal with a lack of confidence by increasing liquidity really means that we're doubling down on the disease while we are dealing with the symptom that bothers us. Throughout time, periods of economic excess have always led to periods of economic decline. That's normal and natural. Unfortunately, we occasionally need to let nature take its course and reinforce the discipline that a market has on an economy. We've chosen not to do that for a period of 20 or 25 years, which means that we have financed our problem, put it off to deal with at a later date. And at some point in time, perhaps now, those chickens come home to roost.
We've seen a lot of interesting firsts in the marketplace in the last few weeks, one of which is the negative prices in oil futures. What can you tell us about that in terms of how it signals global demand?
I think it goes to three things. It's a fascinating discussion. The first is that we have never seen demand destruction in a commodity as quickly as we saw demand destruction in oil with the COVID-imposed lockdowns of air transport and surface transport. Oil demand is estimated to have fallen by 15 million barrels a day, which was offset, ironically, by production increases in both Saudi Arabia and Russia as they duked it out over key markets in Western Europe and Asia. So the circumstance with surplus excess production and then demand falling away meant that we literally began to run out of places to put oil, particularly in the United States. The other thing it points out is the increasing securitization of all markets, including the oil market. What happened basically is that people who played the futures market all of a sudden figured out that if they took delivery, they couldn't cash settle. If they took delivery, there was no place to put the oil. This is a very temporary phenomenon, but it's instructive for people to understand that markets that prices are set ultimately in the market, and that while markets are messy, the cure for low prices is in fact low prices, and the cure for high prices will be high prices. It's also worthy to note, if you're a commodities investor, precious metals or other types of commodities, that the increasing securitization of commodities, the fact that they increasingly change hands as derivatives rather than in physicals, will continue to impact the trading environment for commodities for the foreseeable future. And investors need to take that into account.
But Rick, would you not see low energy prices as a constructive opportunity for other investments? Let's say mining companies, as energy costs go down, their fixed costs could also go down, boosting their margins. Would that not be a phenomenon that you could see happen?
I could not agree more. The lower oil prices has the impact of a tax cut. Basically, it lowers people's cost of living. It positively impacts every level of society, except, of course, energy investors like myself. But the truth is that lower energy prices are an enormous net gain to the economy. And as you point out, a huge gain to energy-intensive businesses like mining.
Absolutely. On the markets now, we're seeing stocks go up today on Tuesday, and generally speaking, we've seen an uptrend in the last month or so. Has this really reflected the underlying fundamentals of the economy, Rick?
Broad equity markets, I think what you're really seeing is the impact of central bank and Fed buying in the markets. You're seeing the confidence in broader markets that has to do with the incredible amount of liquidity that's been added to the market. But in terms of U.S. markets across all asset classes, debt, junk debt, equities, collateralized mortgage obligations, every range of security in the United States has been impacted by direct Fed buying. I watched the Fed jump into the junk bond market 2 weeks ago, and it was a truly awesome display of strength. What you can do with other people's money, or if you will, funny money, by buying up the index, which causes the index managers to have to buy up all the constituent issues in the index, is scary. If the Fed is able to walk the fine line between continuing to counterfeit, that is, induce extra liquidity, without undermining the market's confidence, both in the currency and in the markets that the Fed is choosing to prop up, who knows? This gamble may work for a while. It worked in 2008. The truth is that most investors want to believe that the big thinkers of the world, the political class, the central banks, will somehow stick handle through this crisis so that they as individuals aren't responsible for their financial future. I myself am skeptical about the success of this adventure, but it will be interesting to watch.
You brought up junk bonds. How are you analyzing the credit markets now? Are we at risk of a large systematic default at the corporate level, or can this be avoided?
I am terrified of the debt market, particularly the junk debt market. If you have a circumstance where prices are set on the margin and companies' profits are a function of that margin, the unwinding of the excesses of the last decade, combined with the very sharp contraction in economic activity that have occurred as a consequence of the coronavirus, means that left to their own devices, many borrowers, government borrowers, corporate borrowers, and private borrowers, will run afoul of reasonable guidelines with regards to their credit facilities. Imagine, as an example, a Canadian oil and gas producer that was doing okay. They were well within their guidelines at $60 oil. That same producer at $20 oil absolutely cannot service their debt. I'm not picking on the oil industry particularly. Let's look at the hotel industry. Let's look at the airline industry. The manifestation of this is that at the corporate level, the senior secured investment grade debt will likely take a hit unless the economy does better than I believe. But the hits that might occur in the junk debt market, if the government loses control of the confidence in that market, I think could be very, very dangerous. And let me elaborate on that just for a moment. A lot of that junk debt in the U.S. market is held in exchange traded funds, high yield funds. And those funds are extremely, extremely liquid. They trade millions and billions of dollars a day. The problem is that some of the assets that are held by those funds are illiquid. They don't trade very much at all. And if we have a crisis in confidence in credit markets, if individual investors begin to liquidate the ETFs and the managers are forced to sell the underlying assets to finance the liquidations, you could have a circumstance where many of the individual issues effectively go no bid, where there's a plethora of sellers, but there are no buyers whatsoever. I'm not saying this is going to occur, but it's something that investors in every class of assets, whether or not they're investors in high yield securities or whether or not they're equity investors in companies that have funded themselves in the sub-investment grade debt market, need to take into consideration. The balance of this year should be very interesting, perhaps in the context of that Chinese curse about living in interesting times.
Let's bring it back to gold in the resource sector now, Rick. You've talked about mining a bit. Let's narrow down on that a little bit more. Do you see the low interest rate environment right now conducive to more exploration in the future?
I think the exploration market's going to have to wait a little bit. In my experience, precious metals bull markets move first with the metal, that is to say, gold moves first. Then the biggest and the best gold mining companies move next. The gold bugs were severely punished last decade, and they're tiptoeing rather than galloping back into the sector. And they will buy the biggest and the best names. When the generalist investors come into the space, they will also buy the biggest and the best names. When that happens, a value disparity results between the biggest and the best of the rest. And some investors will go down market to play catch up. Well, merger and acquisition activity will pick up as the big companies buy the other companies. As the sector itself begins to perform, and the cost of capital that the sector enjoys declines, then you will see the exploration sector pick up. The caveat to that is that the industry has underinvested in exploration for many, many years, and the exploration and development pipeline is very constrained. So companies that enjoy successful exploration efforts will see themselves rewarded extravagantly in the market. But for the next year or something, my suspicion is that leadership in the exploration sector will be very, very constrained. Well, where the market will reward extravagantly very successful efforts and ignore the broader sector.
You brought along a chart that you wanted the viewers to see, a gold equities index chart. And tell us a little bit about this chart and what it shows. How well do valuations of gold companies stack up to historical levels now?
The chart is significant in a whole bunch of ways. The first is it's a very, very broad index, and it goes back 50 years. So it's a wonderful historic sort of continuum. What I want to show is the periodicity, first of all, of oversold bottoms, and the fact that the oversold bottom that we have been through, beginning in 2011 and existing through 2019, was both very long and very deep. It's important that investors understand the bear market that we went through in the historical context. It's also important for people to note the incredible cyclicality of the gold equities. There have been on that chart 8 major recoveries from oversold bottoms. And speculators should note that those recoveries have varied in scope between 180% equity index gains and 1,200% index gains. The point of this is simply that when bull markets take hold, they really, really, really move. So I think it's important for people to understand in a cyclical industry like gold that the bear market that we have been through was unusually deep and unusually severe. I think it's important to note that we are either approaching the bottom, at the bottom, or my suspicion is just off the bottom, and that the recovery that we are likely to enjoy, at least if history repeats, I think could be very, very dramatic. I think that this chart really shows where we are and where we could go, which is why I choose to highlight that chart.
What could come first this time, a recovery in the gold equities or a recovery in the base commodities? And when I say base commodities, I mean underlying in terms of precious metals and possibly base metals.
I think that the gold move is already underway, and that's been consistent with all of the recoveries. Gold has to move before the gold stocks move. But I think that condition precedent has been put in. With regards to the broader commodities group, the industrial materials, I think we have a recession to suffer through before they move. I wouldn't doubt that we will see the bottom in pricing in industrial non-precious commodities this year. But my suspicion is that you will have to see further supply destruction and a bit of demand creation, that is a bit of economic recovery, before you will see material recoveries in the prices of things like zinc, copper, oil, uranium, that sort of broad commodities complex. Now, my suspicion is that the next 5 years may be very good for natural resource investors, with precious metals equities enjoying a 2 or 3 year bull market, and somewhere towards the end of that bull market, the rest of the commodities complex catching fire. It's important to know that resource businesses are notoriously capital intensive and cyclical. And so really, as the gold index chart shows, these bear markets that we go through are the authors of bull markets, and bull markets are the authors of bear markets. And the point of these two charts, the gold chart and the commodities chart, is simply to show you where we are in the historical context. Again, I think that precious metals and precious metals equities will do well, will move up as a consequence of the policy response to the economic slowdown. I think the rest of the commodities group is going to have to wait for two things: supply destruction wrought by low prices and an economic recovery wrought by time.
So in light of all this, where do you see gold headed?
Higher. Gold moves as a consequence of people's lack of faith in the ongoing purchasing power of their fiat currency denominated savings. Quantitative easing debases the currency. Excessive debt and deficit makes people demand a higher yield on their bonds at the same time that bond yields are at artificially low prices. My experience has been that the most important determinant of the gold price is real interest rates, and real interest rates are negative. By way of example, the yield on the U.S. 10-year Treasury, as of sort of today, is 60 basis points, that is 0.6%. The Congressional Budget Office suggests that the purchasing power of the U.S. currency is declining by 1.6% a year. So the value proposition is that you lend the U.S. government money for 10 years, and they absolutely promise to reduce your purchasing power by 1% a year for 10 years. Jim Grant calls this return-free risk. So the instrument that gold has to compete against for investors' favor for the next year is return-free risk. And I think gold is up to that challenge.
Finally, Rick, we promised the viewers that there is a way for them to participate in this discussion as well. You have a website where investors can submit what they're holding and what they're investing currently. Is that correct?
That is correct. I found that the best form of education is direct. That is, customers are interested in esoteric discussions of interest rates and the gold price, but they're much more interested in learning these lessons in the context of their own portfolio. So if your listeners will go to the link that you will display with this interview, and they will enter their natural resource equities holdings, I will rank each of those holdings personally, 1 to 10, 1 being best, 10 being worst, and I will comment on individual issues where I think my comments might have value. In addition, I will forward to your listeners the two charts that we have referenced. the gold mining index chart and the commodities chart. Please be patient and please remember to input both the names and the symbols in the body of the email. And as I say, on a no obligations basis, I will respond to every submittal by ranking myself individually the natural resource companies that are submitted. Please do not submit things like Royal Bank of Canada or companies that are non-resource where my opinion wouldn't have much bearing on anything.
Please do, if you're watching, submit your responses. Rick Rule is an excellent resource. You don't want to miss this opportunity. Rick, I'm very thankful you're able to have time today to come on the show, and thank you for sharing your thoughts.
I enjoy these interviews, David. I look forward to visiting with you and your audience, so let's schedule them as you believe appropriate.
Thank you very much. We'll be following up soon. And thank you for watching. We'll have more for you on Kitco.com, so stay tuned.